Welcome to Capital Allocation Lab Calm, audio-first lessons that turn classic investing ideas into, well, better decisions for business owners and long-term investors. If that sounds like you, tap subscribe and like to support more educational episodes.
Yeah, and today we face that invisible thief,
Mhm.
the one working on every balance sheet. Inflation. We're going to unpack Benjamin Graham's Chapter 2, The Investor, and inflation. It's really crucial stuff.
Absolutely. We'll get into why stocks are maybe only a half hedge, and that disciplined 25-75 allocation anchor that Graham proposed, it's all about defending purchasing power.
That's the goal. You should leave this with a simple policy you can actually use, maybe even this week.
And we'll have a quick quiz, too, just to test your grasp of real returns, not just the nominal ones everyone talks about. Okay, let's start.
So Graham's point is pretty blunt, really. Inflation shrinks purchasing power. Simple as that. It hits anyone holding dollars at a fixed claim. Think wages, bond coupons, the principle itself.
And it's not like this is some new phenomenon, right? It's been around forever, shows up in waves all through history.
Exactly. Graham wasn't, inventing the concept.
And back when he was writing around the 72 editions, he was actually assuming something like 3% annual inflation going forward, based on the couple of decades before that.
Yeah, steady, but definitely not trivial. But the key thing wasn't nailing the exact number.
Right. The idea wasn't prediction, it was preparation, planning for it.
Plan for it and plan like an owner. Dividends might grow, earnings might grow, but you just can't assume they'll always beat rising prices. And that really sets up his next warning.
Okay, so that leads right into this common belief, maybe a misconception, that inflation goes up, so stocks go up.
Well, Graham says pretty emphatically, not necessarily. It's just not that simple.
So there's no, tight link in time between CPI jumping and stock earnings or prices following right along.
Exactly. That's the core of this half-hedge idea. Think about the late 60s, for example.
Oh, yeah.
The cost of living, it rose about 22% between 66 and 70. That's significant. But broad earnings and stock prices, they actually fell during that time.
Wow. So if you bought stocks just because you were scared of inflation, but you bought them when prices were already high.
Yeah, sorrow tends to follow, as Graham put it. You end up compounding one mistake with another.
So over the really long haul, decades maybe, equities often do outpace inflation.
Often, yes. And this is a big, but not always. And especially when inflation gets really high, those failure rates, stocks failing to keep up, they climb.
So the conclusion is pretty clear then. Stocks are an imperfect hedge, a half hedge at best.
Precisely. It's not the guaranteed shield some people think it is.
Which brings us back to psychology. Graham always emphasized that, didn't he? The investor's chief problem.
Absolutely. And with inflation, the big trap is what he called the money illusion.
The money illusion.
Yeah.
That's basically thinking in just the numbers on the page, the nominal dollars, instead of what they actually buy.
You got it. Thinking in nominal terms, not real purchasing power.
Okay, let's make that concrete. Quick example. Your account statement shows you're up, say, 6% this year. Feels good.
Right, looks like a win. But if inflation during that same year was, let's say, 4%.
Then you didn't really gain 6% in buying power.
Not even close. Your real return, the actual increase in what you can buy, is closer to, well, the math is roughly 1.06 divided by 1.04 minus 1, which is about 1.9%, not 6.
That difference, that gap, that's the thief. The money illusion lets it sneak in.
And the 1970s really hammered this home. Prices more than doubled in about a decade, from roughly 73 to 82.
Anyone who lived through that, yeah, they know protecting purchasing power isn't just some academic exercise.
It's survival. It's everything.
Okay, time for a quick check-in. Quiz pause. Question 1. What's the name of that bias, the one that makes investors cheer nominal gains even when their real returns are negative? Pause.
That's the money illusion.
Okay, question 2. For a defensive investor, what was the specific stock allocation range Graham insisted on? You couldn't go below or above these numbers.
Never below 25% or above 75% in stocks.
Right. So if stocks aren't this perfect hedge we talked about, and bonds, well, they can get hammered by inflation or rising rates. What's the answer then?
The answer, according to Graham, is compromise. Not trying to be a hero, just finding a balance.
Balance how?
Keep meaningful stakes in both stocks and high-grade bond-type holdings. You need both.
And that's where the 25-75 comes in for each side.
Exactly. Each one has to be between 25% and 75% of the total portfolio. 50-50 is obviously the simplest starting point.
But the real magic isn't just picking a number, right? It's the rebalancing.
That's the key. That's the discipline. When stocks have a huge run-up, maybe getting ahead of themselves, the rule forces you to trim them back, sell some high, and add to your bonds.
And the flip side, when stocks tank and everyone's panicking.
You're forced to buy low, adding to your stock position, using funds from the bond side. It makes you act countercyclically.
So you get this owner's discipline that pushes against the crowd's fear and greed. The policy dictates the action, not emotion.
Precisely. Takes the guesswork and a lot of the psychological pain out of it.
Okay, but what about things? What about gold, art, collectibles, stuff that feels solid, inflation-proof?
Ah, yes, the lure of tangible assets. Graham was, let's say skeptical. Very skeptical, actually.
Why skeptical? Seems intuitive.
Well, from a defensive investing standpoint, over long periods, many of those things, they don't produce any cash flow. They often have costs, storage, insurance, whatever.
Okay.
And critically, history shows they often fail to actually protect purchasing power reliably. So a defensive policy shouldn't rely on speculative collectibles or, commodities like gold.
So it's about productive assets versus hoping someone else pays more later.
Exactly. Speculation versus investment.
Got it. But things have changed a bit since Graham wrote. Are there modern tools that fit into this framework?
There are. And two big ones kind of reinforce his core idea. TIPS and REITs.
Okay, tips. Treasury inflation-protected securities. How do they work?
They're government bonds, but the principal value adjusts upwards with the CPI. So they directly help preserve the real value of that bond part of your portfolio.
That sounds like a direct inflation hedge for the bond side. Any catches?
The main one is taxes, that inflation adjustment. It's taxable income in the year it happens, even though you don't get the cash until maturity or if you sell.
Ah, okay. So probably best held in tax-advantaged accounts like an IRA or 401k.
Generally, yes.
Yeah.
That avoids the annual tax hit on the phantom income.
And the other one, REITs, real estate investment trusts.
Right. REITs let you own a piece of a diversified portfolio of real estate, think office buildings, apartments, malls, run by professional managers.
So you get exposure to real estate, which often passes through inflation via rents and property values.
Yeah, there's often a partial inflation pass-through.
Yeah.
And you avoid the headaches of owning, say, a single rental property directly.
But they're not a perfect solution either, I assume.
No, definitely not a magic shield. Because they trade like stocks, REITs can be really sensitive to interest rate changes. When rates spike, REIT prices can fall, even if the underlying property values are solid.
So like TIPS, they're tools to blend into the 25-75 framework, maybe as part of the equity slice, not some kind of replacement for the whole strategy.
Exactly. Blend them in prudently. Don't just bolt them on thinking they're a cure-all.
Okay, this brings us to some concrete actions. Based on all this, what are, say, 3 moves someone could consider this week?
All right, 3 things. First, measure in real terms. Seriously, go back maybe 5 years, look at your nominal return, then look up the CPI over that same time. Calculate your real return. That number can be sobering.
Right, cut through the money illusion right away. Okay, second.
Second, codify your range. Decide on your stock bond corridor. Maybe it's 40-60 to 60-40, maybe tighter, maybe wider. Then set a clear rebalancing trigger, like if either side moves 5% or 10% away from the target, you make the trade. No hesitation.
Make it mechanical, removes the emotion.
Got it.
And
Third, modernize prudently. Think about whether TIPS make sense for the bond side of your retirement accounts. Maybe consider a measured slice of diversified REITs for the equity side. Use these tools to reinforce the defense, not to chase returns.
makes sense. It all comes back to structure.
Yeah, we can't forecast inflation accurately. Nobody can consistently. But what we can do, using Graham's insights, is design a portfolio that doesn't need an accurate forecast to survive.
A portfolio built for resilience, not prediction.
That's the essence of defensive investing.
This is Capital Allocation Lab. Classics re-explained for today's owners. No hype, just ideas that hopefully improve judgment.
And if you found this deep dive useful, please like the episode and subscribe. It genuinely helps us keep these lessons free for everyone.
Yeah, we appreciate it. Comments are welcome too. Maybe tell us your real return over the last 5 years if you calculate it. Or let us know what fundamental concept you want us to tackle next: dividends versus buybacks, ROIC versus ROE, maybe Mr. Market in practice.
Thanks for joining. Thanks for listening. We'll see you next time.